What if I told you that thousands of Canadian seniors right now are sitting on a ticking time bomb? And most of them have absolutely no idea. Not a rumor, not clickbait. The CRA has quietly updated how it treats certain property situations in 2026. And if you're a senior who owns a home, received an inheritance, or helped a family member with real estate in the last few years, this could cost you. We're talking $10,000, gone, just like that. Stay with me, because by the end of this video, you're going to know exactly what's happening, who it affects, and most importantly, what you need to do before it's too late. Welcome to Credit Smart Canada. Let's set the scene. You've worked your whole life. You paid off your mortgage. Maybe you helped your son or daughter buy their first home. Maybe a parent passed away and left you the family house. You thought you did everything right. And then one day, you get a letter from the CRA, an audit notice, a reassessment, a penalty. And suddenly, everything you thought was safe isn't. This is the reality hitting seniors across Canada right now. And it's happening quietly, without fanfare, without a press conference, without anyone warning the average person sitting at their kitchen table. So let's talk about what's actually changed. The CRA in 2026 has significantly tightened its scrutiny around what's called the principal residence exemption. Now, if you've heard of that before, great. If you haven't, here's the simple version. When you sell your home, you normally don't pay capital gains tax on the profit because your primary home is protected under this exemption. That's been the rule for decades, and most Canadians have relied on it without ever having to think twice. But here's where it gets complicated, and here's where seniors are getting blindsided. The CRA has ramped up reporting requirements and is now cross-referencing property data, land transfer records, and tax filings in ways it never did before with this level of aggression. If there is any inconsistency, any gap in how a property was reported, any year where the designation wasn't properly filed, any situation where a property changed hands within a family and the paperwork wasn't airtight, they're coming for it. And seniors are disproportionately affected for one very specific reason. Many of them have been in their homes for 20, 30, even 40 years. The rules around reporting the sale of a principal residence have changed multiple times over the decades, and not everyone kept up. Here's a situation that is playing out right now. A senior sells their home after living there for 30 years. They assume the principal residence exemption covers the full gain, and it should. But if there was ever a period, even 1 year, where the property wasn't properly designated on their tax return, the CRA can now challenge that. And when you're talking about a home that went from $200,000 to $800,000 in value, one unclaimed year can trigger a capital gains reassessment that wipes out $10,000 or more in a matter of months. And it doesn't stop there. Seniors who added a child's name to the title of their home, something many people do for estate planning purposes, may have unknowingly triggered a deemed disposition. That means the CRA could treat that name change as a partial sale. Without proper planning and documentation, that helpful move to avoid probate could now be seen as a taxable event. Nobody told them. Their well-meaning family didn't know, and now there's a bill. There's also the inherited property situation. If a parent passed away and left a property to their children, and that property wasn't reported correctly in the estate, or if the adjusted cost base wasn't documented properly, the CRA's new data matching capabilities can flag it years later. Years later. When the surviving senior child goes to sell that property, they're hit with taxes they never anticipated, on gains they never actually pocketed. Now, I want to be clear here. I am not saying the CRA is doing something illegal. These are tax rules that exist for a reason. What I am saying, loudly and without apology, is that the enforcement has escalated. The data technology the CRA is using has improved dramatically, and the window of time you have to clean up any loose ends is closing, fast. So what do you actually do? First thing, if you have sold a home in the last 3 years and did not explicitly designate it as your principal residence on your tax return, you need to talk to a tax professional immediately. Not next month, not after the summer, now. The CRA does have a voluntary disclosure program, and acting before they contact you gives you significantly better options than waiting for the letter to arrive. Second, if you are planning to sell your home, do not assume the exemption is automatic. Sit down with a CPA or a tax accountant who specifically understands real estate and the principal residence rules. Have them review your filing history. Make sure every year of ownership is accounted for. Get it in writing. Third, if you've added a family member's name to your property title, or if you received property through an estate, pull that paperwork out right now and get it reviewed. The adjusted cost base, the date of acquisition, the original value, all of that needs to be documented. If it isn't, you are exposed. Fourth, do not rely on general advice from friends or family members who went through something similar. Tax law is specific. Your situation is unique. What worked for your neighbor in 2019 may not apply to you in 2026 under these new enforcement patterns. The reason this matters so much, the reason we're covering it here on Credit Smart Canada, is because the people getting hurt the most are the ones who did everything right their whole lives. They saved. They paid their taxes. They invested in property because that's what you did. And now in their retirement years, they're facing penalties and reassessments that they are completely unprepared for, financially and emotionally. $10,000 for a senior living on a fixed income isn't just a number. That's months of groceries. That's medication. That's the heating bill through a Canadian winter. That's the trip to see the grandkids that gets canceled. This is real, and it is preventable, but only if you act now. If this video helped you understand something that nobody else has explained clearly, do me a favor. Share it. Share it with your parents. Share it with a friend who just sold a property or is thinking about selling. Share it with anyone you know who is dealing with an inherited home right now, because the best thing we can do for each other is make sure nobody gets blindsided by something that could have been avoided. Here on Credit Smart Canada, we don't sugarcoat things. We give you the real picture so you can make the best decisions for yourself and your family. If you haven't subscribed yet, hit that button right now, because we cover exactly this kind of critical, real-world financial information every single week. Leave a comment below and tell me, has the CRA contacted you about a property? Are you dealing with an inherited home situation? I read every single comment, and your story might just help someone else in the same position. Don't wait. Protect what you've earned. We'll see you in the next one.